Here again with Smart System. In our last lesson, we learned about the relative strength index and some different ways that traders use this in their trading. In today's lesson, we're going to learn about another momentum oscillator, which is known as stochastics. So let's get started. There's three different types of stochastic oscillators: the fast stochastic, the slow stochastic, and the full stochastic. All these operate in a similar manner, however, and when most traders refer to the stochastic, they're talking about the slow stochastic. So that's going to be the focus of this lesson. The basic premise of a stochastic is that prices tend to close in the upper end of their trading range when the financial instrument you're analyzing is in an uptrend, and in the lower end of their trading range when the financial instrument that you're analyzing is in a downtrend. When prices close in the upper end of their range in an uptrend, this is obviously a sign that momentum in the trend or momentum of the trend is strong, and vice versa for a downtrend. The stochastic quote contains two lines, which are known as the %K line and the %D line. I'm not going to go into the formulas for each because most charting packages are not all charting packages. So packages that you'll use will calculate these lines for you. However, you should know that this is a momentum oscillator. So when the %K line is rising, that is an indication that momentum in the market is increasing. And when the %K line is falling, it's an indication that momentum in the market is decreasing. %D line is very simply a simple moving average, a 5-period simple moving average of the %K line, and it acts to smooth out the price action of the indicator and slow it down a little bit, and also acts as a signal line for the faster %K line, which we're going to learn about later in this lesson. It's a banded oscillator just like the RSI. It fluctuates between 0 and 100, and the upper end of the range is marked by line at 80, and the lower end of the range is marked by line at 20. The first way that traders use this is a trade overbought and oversold levels. George Lane, who invented the indicator, recommended waiting for a cross back below the 80 line when the market went from an extremely overbought area before placing a trade to the downside, and waiting for a break back above the 20 line before signaling a trade to the upside. So you see here you have the overbought area, you have the break below the 80 line, and then you do have a sell-off that results after that. You have an oversold area here, you have a break back above the 20 line, and then you have a rally again. Hindsight is 20/20, and there are going to be false signals with this indicator, as with any other indicator that we're going to look at. One of the ways to reduce the amount of false signals that you're going to get is by combining indicators and combining methods of analysis using some of the things that we've learned so far. So here you have a false signal. The indicator was in an overbought area, traded back below the 80 line. You did not have a sell-off after that, but hopefully if you'd have watched our lessons on trends and our theory, you've been watching this strong uptrend here, and you would not have been taken into that trade there to the downside, because there was not a break of that trend line here. However, there was a break of the trend line, and you had not only the break of the trend line, which is a very strong signal, but also the break back below the 80 line of the oscillator, and you did have a sell-off as resulted after that. Second way this can be traded as crossover signals. Remember from earlier, the %K line is the faster line, the %D line is the slower line. So when the %K line crosses above the %D line, this is an indication that it may be a good place to buy. And when the %K line crosses below the %D line, this is an indication that it might be a good place to sell. And this is basically a way for aggressive traders to catch earlier signals, particularly from overbought and oversold areas. So you can see here, we've got a bearish cross from our overbought area. We've got the bearish cross with the %K line trading below the %D line, and we've got the break below 80 there. However, you could have gotten in earlier into the trade, had been trading the bearish cross from the overbought area instead of waiting for the break, but that's not recommended. And this indicator, like the cross of the RSI, is very prone to false signals, so be careful there. The divergence is the third way, and very simply, when the market is making new highs and when the market is trading in the opposite direction of the indicator, that's an indication that a reversal may be coming. So you have divergence here. And as you can see, the market's making new highs there, but you can see by looking at the stochastic that momentum in the market is not following upwards. That might be a good place to look for a sell trade. If you remember from previous lessons, hopefully you'll also see something else there, which is a double top. So you have two things confirming that might be a good place to place a sell trade. You have the divergence plus the tripod in there, the double top, and you do have a nice sell-off that results after that, as you probably noticed in this lesson. The stochastic oscillators very similar to the RSI, and they are both momentum oscillators. So many traders will use one of the other. They'll try out both and figure out which one works better for them, for identifying the momentum and whatever instrument they're trading. And another way that it's used is in conjunction with the RSI to confirm each other. So to confirm opinions on momentum. So that's our lesson for today. And next lesson, we're going to look at an indicator, which is known as Bollinger Bands, which is going to give us a picture of the volatility in a particular financial instrument. So we hope to see you in that lesson. If you have any questions or comments, please feel free to leave them in the comment section. Have a great day.